The mortgage slump is settling in, more Americans are quitting their jobs, and we're going to tell you what Warren Buffett would do. You're in the right place, folks, because this is where the money is. Welcome to the show. I'm Matt Copenheffer, and next to me, as always, is David Hanson. And David, as a start to our show today, there's an article in the Wall Street Journal talking about the changing face of finance, and in particular how it's been impacting Morgan Stanley. Here's what that article said. One small sign of the times, the cigar shop on the ground floor of Morgan Stanley's Times Square headquarters, a favorite of former chairman Richard Fisher, decamped downtown in 2011 because business was poor. The space is now occupied by a bakery that sells mini cupcakes.
Everybody wins.
Everybody wins.
Healthy alternative.
Investment bankers no longer smoking cigars, eating mini cupcakes. What's your mini cupcake of choice, David?
Red velvet.
All right, red velvet, you heard it here. Moving on to the headlines.
The real headlines.
The real headlines. The first headline of the day here, Wall Street Journal says that Alcoa, Hewlett-Packard, and Bank of America to be dropped from Dow Industrials. Nike is in, Visa is in, Goldman Sachs is in. David, is this disaster for Bank of America?
It's a complete disaster. No, it doesn't matter at all. The Dow it's just an index. Money managers don't really even pay attention to the Dow. S&P 500 is looked at much more often. Bank of America was added back at the beginning of 2008, so it's been a rough ride for Bank of America in the Dow. That was right after they purchased Countrywide, and Bank of America as a whole has lost around $34 billion in market value when it was added in the Dow. So maybe they're glad to get out of there.
Here's what I love about the Wall Street Journal article and this whole thing in general, and this is a good reminder of why it doesn't make a lot of sense to pay attention to the Dow. Here's a quote from the article: "The changes," and this is from the Dow committee, "the changes were prompted by the low stock price of the three companies slated for removal and the index committee's desire to diversify the sector and industry groups." So I said to myself, I'm probably misunderstanding that. It probably really doesn't have to do with how high or low the stock prices are. That's crazy. That doesn't make any sense.
But
why would you choose the index based on stock prices? But then I looked at the stock prices. Hewlett-Packard trading at $22, Alcoa trading at $8, Bank of America trading at $15, roughly. Visa trading at $183, Goldman Sachs trading at $165, and Nike trading at $67. They are literally building this index around how high or low the stock prices is, how low the stock prices are, pardon me.
Big numbers are better.
Mind blown. My mind is blown. All right, moving on to the second headline.
Next one,
for it.
We're going over to Bloomberg. The headline is, B of A cuts jobs as mortgage slump ensnares JP Morgan, Wells Fargo. Never good to be ensnared.
Don't want to be ensnared.
So B of A cutting back on some mortgage jobs here. It was interesting because B of A was one of the companies that was kind of caught on their heels with the refinancing boom. So they didn't have enough loan officers out there. Refinancing boom happened. They increased the amount of loan officers and call center support staff, and now they're kind of having to go back on that as refi volume slows down. And interesting, the article also notes that yesterday, Wells Fargo CFO Tim Sloan came out and said they expect origination volume this quarter to be lower by 30%. Still $80 billion. They're still the leader in the industry there, but down 30%. JP Morgan came out and said they expect mortgage banking to operate at a pre-tax loss the next couple quarters. So it's kind of crazy how these things can shift so quickly from being very profitable to losing money.
So I've got my notes right here for this headline, and my note for this says, yeah. We kind of saw this coming, right? This was bound to happen. Refinancing activity was way above normal. The banks were raking in tons of money from it. And in the long term, what we really want to see are moderately higher rates. We obviously don't want to see interest rates go crazy like the 1970s and early 1980s. That creates a difficult situation of a whole different variety. But we want to see the spreads that banks can earn expand a little bit. They're super, super low right now. And rising rates will do that, but it will also hurt the refi boom. I think this is what's to be expected, and this is what the banks need to do is take headcount down, take out some of the expenses from that business so that it's not an unprofitable business at lower volumes.
Right.
Third headline, Wall Street Journal again, JP Morgan juices up director's job. This refers to the fact that Lee Raymond of ExxonMobil is now named the lead independent director, is what they're calling him over at JP Morgan. Is this going to change everything? No more problems at JP Morgan. No more of these bad headlines, reputational risks, all thing of the past, right?
It's hard to say unless something comes up again that makes the board look really bad. I mean, if nothing happens and everything's quiet, everyone's going to say, this was a great success. They fixed everything. But if something does come up and happen, they'll say, look, nothing's changed. I see it as a slight positive. At least they're trying to make things a little bit more independent, trying to take some power away from Dimon if you thought he had a little bit too much. I see it as a very slight positive. That's it.
So here's, I'll reiterate my view again on Jamie Dimon. Coming out of the financial crisis, everybody thought Jamie Dimon was the second coming, the best thing since sliced bread. And then magically that changed. The London whale had something to do with that, had a lot to do with that maybe. And then all of a sudden Dimon was a pariah. I've always tried to keep kind of the middle ground on Dimon. I think he's a good banker. I think he's a solid banker. I'm fine with him being CEO and chairman. As a shareholder myself, I'm fine with him being CEO and chairman. The one thing, the one failing that I think Dimon has had as CEO and chairman, and this appointing Lee Raymond to this lead independent director role may change that. There's not a solid succession plan in place. And one of the jobs that Raymond will have as this lead independent director is helping put that succession plan into place. And I think that'll be a good thing for JP Morgan, a good thing for shareholders, even if Dimon is going to stick around. It's a good idea to have a succession plan in place. So this week, over the pond, Barclays Global is holding a global financials conference, and a lot of the companies that we cover are going to be presenting at this conference. A few presented yesterday. We've got a bunch today. We've got some more tomorrow. And you took a look at a couple of the banks, a couple of the regional banks here in America that were presenting at this conference.
Right. So the first one we'll look at is PNC. And the CEO, Bill Demchak, he made his presentation, and I picked out 3 focus areas or 3 main takeaways from that, and we'll throw them up here. So the first one is penetrate newer markets. Not new markets, newer markets. So when I'm talking about penetrating the markets, I'm talking about southeastern United States. That's really where they moved into the last couple of years. So their points were that they really want to focus on building out their commercial business there, making relationships with clients there. And that's really Bank of America, Wells Fargo's backyard right there in the southeast. So that's one of their main priorities going forward. The second one is the wealth and investment management business. This is something that they said they hadn't invested in this business very much. But going forward, they see this as a business that's very profitable. It's not very asset heavy. So going forward, that's going to be one of their main focus areas, is building that out. And they said that anyone who has a customer-facing role, whether it's a teller, mortgage banker, there's a push, there's an incentive to get more of those assets under management into that wealth management business. And the third and final point on there was optimize the residential mortgage business. It's kind of interesting because we just talked about how this business was scaling back and refi was falling off of a cliff. But they said their focus hasn't historically been refi activity as much as it has been actual purchase volume and actually making customers with the people that are getting mortgages. And they see this as, they said, a brand enhancer. If they can get mortgages with people, then they can sell checking accounts, they can get the wealth management business. So I was very encouraged by what I heard from them. I thought their strategy looked very good, and I think they have a good chance of executing on these.
Great. And I think you also took a look at KeyCorp as well. How did the two stack up to each other? They're
a little bit different, and I have 3 points for KeyCorp as well here. So I'll throw those up. The things that stood out to me were slow loan growth. Now, KeyCorp, they do some consumer lending, so like people like you and I, but their main focus is the middle market business
I'm a business,
client.
David. I don't know what you're
Matt Copenhaver, LLC, of course.
I am the business.
And they kept going back to that they're just not seeing a lot of loan demand out there from those middle market clients. So not huge businesses like Walmart, but not really tiny mom and pop shops. So the mid-sized businesses out there, they're not seeing a lot of loan growth in that area, which is a little bit disappointing. The second thing that I highlighted there is dividend increase, question mark, excess capital. And this was a quote from CFO Don Kimball. He said, "We have too much capital at this level."
Which is frankly the case with a lot of banks right now, I think.
So they are well above Basel III. So I'm not going to get into the whole Basel stuff, but they're well above their Basel.
They have a
III
lot of money. They have a
requirements.
lot of money sitting around. They're basically, if we picture Scrooge McDuck diving into big pools.
Exactly. So they have all this capital waiting to be deployed. They're not getting the loan growth. So the next logical explanation would be, well, they should increase the dividend. That's where the Fed comes in. They need Fed approval to increase that dividend. But going forward, it appears they're in a good position to increase that the next couple of years. And then the last point I made was middle market clients. I mentioned before, this is really their strategy. When we talked about PNC, they touch consumers, they touch big businesses, institutional investors. KeyCorp has a little bit of that, but their main focus is middle market customers. So it's going to be very important going forward to just deepen those relationships, continue having expertise in that area, and we'll see if they can do it.
Based on these two presentations, this is a very small window into both of these banks. Based on these two, which are you buying? Which are you avoiding?
I would be buying PNC based on this information, not a straight buy, but more bullish on PNC based on what I heard compared to KeyCorp. It seems they have a better feel of what the environment looks like. They said they're not going to go chase loan growth if it's not a good loan to make. They said we're going to make good capital decisions when the decisions need to be made with dividends or share buybacks. So based on what I heard, PNC was encouraging.
Okay, so this was a global financials conference. You looked at a couple of the banks. I took a look at one of the insurance companies there, one of the largest insurance companies in the U.S., Allstate. And before I've got a 3 points just like you. Don't worry about it. But before I get to that, there were 4 factors that the Allstate CEO pointed out that investors get when they're investing in Allstate, and that's differentiated strategy, strong operating performance, so that's current and recent operating performance, a team that adapts, and strong cash flow. So those are good. Those are good things. Those are solid things to expect. Now, here are the 3 things. We can throw those up. So here are the 3 points that I had for Allstate. So first of all, it's still a very agency-heavy business. They were saying that roughly 92% of premiums still originate from the agency business. And now the difference there is that we think about an agent. So that's you get the letters in the mail. If you have a house, you may have stuff dropped off at your house. You've got the little storefront around the corner. It's a person that you interact with that sells you the insurance.
Who gets a commission?
Who gets a commission. And that's as opposed to the Geico Gecko, the Geico Pig, the Flow over at Progressive. So those are direct models. So Geico and Progressive are 2 of the largest in the direct models. That's online, that's over the phone. Those are lower cost in terms of the overhead that it takes to sell that, which makes sense, a person versus just having a call center. So I'm not crazy about the fact from the starting point that Allstate is heavily agency because it has that higher cost component, but it does differentiate it to the extent that some consumers still do want a person to go and interact with. Number 2 point, we've got that Esurance, they've seen strong growth at Esurance. Now, just talking about this direct sales. Esurance, Allstate bought this brand, and it's had some really good growth. In 2012, Esurance had $1.2 billion in net written premiums, and that was 31% growth year over year. So that's pretty strong growth at a time when you're not seeing huge premium growth at insurers. However, here's the drawback. When I think of insurers, what I am generally looking for is strong underwriting. And over at Esurance, the combined ratio is really high. It was 120% in 2012, which basically means 100% is a break-even point. If you're under 100%, you're profitable on your underwriting. So 100%, very unprofitable on underwriting. That unit lost $192 million in 2012. So that tempers my optimism. It's growing fast, but it's losing money on its underwriting. Third point here was homeowners insurance under fire, so to say, or at least it had been. So the homeowners insurance unit at Allstate had some big problems. They had actually toyed with the idea of getting rid of it, but then decided that it was good for the business because a lot of consumers like to package their insurance together, get their auto, get their home, get whatever, all from one place. So they decided to keep it, and they've been in the process of fixing it. Now here's a quote from the presentation yesterday. So, while these actions improve the business, the actions that they took on the homeowners insurance, it did cause a significant amount of customer disruption and required a tremendous amount of our agency's time, both of which had a negative impact on the size of our auto business. So this has had a real impact on the overall business, not just the homeowners. So the hope is that now homeowners is back on the right track. But what was kind of neat about this conference is in the question and answer section, they had polling questions that they put out to the audience. And they asked the audience, how do you feel about the progress that they've made, that Allstate's made on the homeowners insurance segment? And the predominant answer was, it's still too early to tell. And that's kind of where I stand on it. So we're gonna have to watch a little bit. Now, taking this overall, there are things to like about Allstate, and one of the things that I like is in the 4 factors that I said at the very beginning, a team that adapts. That's important, and I think you've seen that, and they talked a little bit more about that in terms of exiting certain businesses and really realizing what their core is. But it's hard for me to get too excited about this. They have a very strong hold in the insurance market. They have a very strong market share, but I think I'd rather be with a progressive, be with a Berkshire Hathaway. The Geico unit is a big part of it, but not an overwhelmingly large part of it. But I just feel like more of the market is moving in that direction. So that's where I'm at. It was an interesting presentation, but I didn't find it truly compelling that got me to the point where it's, I've got to own this stock.
Right.
All right. On the topic of insurance, on the topic of Berkshire Hathaway and Warren Buffett, we're going to go to our game for today, and that is, what would Warren do? Now, what I'm going to do is I've got 4 scenarios here, and on each one of them, we're going to try to figure out what Warren Buffett would do.
Done.
Number 1 scenario. Earlier in the show, we were talking about the slowdown of the mortgage sector, the refinance boom in particular. If Warren Buffett were running one of the big banks as the mortgage market is slowing down, what would he do?
This is easy. He would do what Wells Fargo is doing. That's why he has his money behind Wells Fargo. He would have taken advantage when times were good, and he would have pulled back on the levers like Wells Fargo, like Bank of America is doing, taking expenses out of that. So he would do what Wells Fargo is doing. What about you?
I generally agree with you, and I think that's probably the right answer, probably what he would do. But another answer, possibility, is that he would have kept more of a steady Eddie approach and not bulked up and tried to capture a ton of that business while it was there and cut it back out. It does. On the one hand, there were real and large profits to be gained from it. On the other hand, you create tumult in the company by adding a bunch of people, bulking up the business, and then having to fire a whole bunch of people. It doesn't help morale, I don't think.
Right.
So I'd probably go with yours, but maybe you're wrong.
Maybe scaled back a little bit.
Maybe you're wrong. Okay, number 2. If Warren Buffett were running a smaller specialty insurer, like, say, W.R. Berkley, very well-run specialty insurer that works in a bunch of different markets, similar to some of Berkshire Hathaway's specialty insurance operations, similar to a Markel, their specialty insurance operations. If he were running a smaller specialty insurer, what would he be doing?
Probably the same thing, the same culture that he's instilled at his bigger specialty insurer and insurance operations at Berkshire. He would stay prudent, take the right risks, and he'd be looking where other people are overlooking and where he can get good deals in insurance. So I think he'd be doing pretty much the same, and maybe just finding some smaller areas that he can take advantage of.
I'm going to take your answer and run with it just a little bit more. So I think he would be doing more to reallocate the capital, to put it to work for investors. The insurance business, so on the one hand, you have the insurance, you have the underwriting operations, that can produce a profit. Then on the other hand, you have the investing operations, and that can produce a profit. And then there's also sort of the money that they keep. So a lot of the money that's invested in insurers is really invested until. It's invested until it goes to pay out claims. But over time, as the insurer earns profits, a lot of that becomes shareholders' equity. That's shareholders' money. That's the company's money that they can do whatever they want with it. And there are certain insurers that are just really good at underwriting. So they take any of their profits and they give them back to shareholders. They use the buyback stock or whatever. But then there are some that have really good investors, good enough investors like a Buffett, like a Tom Gaynor at Markel, that they can take it and invest it and make a lot more money over time. So I think at a smaller specialty insurer, Buffett could bring that aspect of it even more strongly than some of the quality underwriters that specialty insurers have.
I agree.
Number 3 scenario, if Warren Buffett were running AIG. Now I've said many times I think Robert Benmosche is doing a great job over there. But what might Buffett be doing differently?
I think he would really, really be hammering home the importance of good underwriting. Benmosche, he has made that an emphasis for the company there. But we just talked about the importance of you have the underwriting, you have the investment. I think Buffett would look at AIG and say, we have to get the culture right. We have to underwrite good insurance. They're getting there. They've definitely improved from where they were. They still have a lot of insurance policies that were there before Benmosche even took the helm there. So I think he would just continue to hammer that culture and really make sure they're underwriting good policies.
So I think that's probably true. Another thing that he might be doing is maybe being a little bit less aggressive about jettisoning what they're calling right now non-core businesses. Mm-hmm. And so I think to some extent that makes a lot of sense, gets them focused. But on the other hand, those are businesses that can earn profits over time. And if you think about Berkshire Hathaway, there are a lot of so-called non-core businesses there other than insurance.
Right.
Okay, final one, a fun one. They're all fun. Over on BuzzFeed today, there was an article, 27 one-bowl desserts. See it right there on the screen. A few of those were peanut butter marshmallow sandwich cookies, snickerdoodles with white chocolate chips, and hummingbird pudding cake. I have no idea what hummingbird pudding cake is. But what would Buffett be making if you were making a one-bowl dessert?
Cherry Coke cake. That's my answer.
What in the world is cherry Coke cake?
He could find someone to make it. He has the cash to do it.
He could find somebody to make cherry.
What do you think?
He would be making nothing because Buffett does not bake.
Okay.
Buffett invests, he does not bake. But if he did, he would probably take a box of See's candies, dump them in a bowl.
Melt it down.
That's his, no, not melt it down, just a bowl of See's candies.
That works.
All right, finishing off as we always do in the Twitter sphere. David, take us out.
The first one we got is a little interesting from Ben Walsh, at Ben D. Walsh. The slightly increased number of Americans quitting their jobs is qualified good news for the economy. What?
Funny news.
Explain.
Funny, yeah, it sounds funny. This comes from the Bureau of Labor Statistics, the BLS. Quits, the number of people quitting their jobs, up year over year. That may not sound like great news, but on the other hand, why do you quit your job? Well, you quit your job when you're feeling confident about the economy. You quit your job when you're feeling confident that you can get another job. So I think Ben is right in looking at this as positive news about the economy.
Cool.
Tweet number 2. We have this from American Banker at AMER Banker. The tweet is, reminder, vote in our poll. Is the decline in the number of community banks good or bad for the industry? That poll is on AmericanBanker.com. Right side, halfway down. David, good or bad?
I think it's good. The community banks, everyone likes to feel warm and fuzzy about them. And yes, that's true to an extent. You get your lollipop for your little kid there. Everyone knows everyone's name. But going forward, it's going to be the banks with the ability to spend on technology that really help the customer, help the industry. And the smaller banks that get bought up, that don't make it, it's a little disheartening, but in the long run, consumers will benefit and the industry will benefit.
What's your Twitter handle again?
At TMF Hurricane.
So, the CEOs of community banks, you can send your hate tweets to at TMF Hurricane.
Fair enough.
Tweet number 3.
Tweet number 3. All right, we got one from our own Jordan Wathen, at JWTHN. The Fed, what great investors have to say, and he links out to his article that he published on Fool.com yesterday. He was talking about, he pulled some old quotes from Seth Klarman, Warren Buffett.
Really great investors.
Some noteworthy guys. And he basically noted that they don't care what the Fed's doing, what I've been saying for months.
You and Seth Klarman, and why didn't he quote you in
My
there?
picture was below the Seth Klarman.
Oh, it was. Oh, I must have missed
right
it.
Below.
I must have missed
But he pulled a quote from Margin of Safety, Seth Klarman's book, and he basically said, no one can predict what interest rates are going to do. They're going to go up, they're going to go down. You can't predict what they're going to do. So he doesn't try to do it, and I think that's what investors should be doing. Do you disagree?
I want to very
can't.
badly, but I cannot. So we will end it there.
Perfect.
Thanks for watching, folks. I am Matt Copenheffer, Hurricane David Hansen, right here. If you want to tweet at us, we're at TMF Financials on Twitter, and you can let us know your favorite one bowl dessert. Thanks for watching, and we'll see you tomorrow.